Hi, everybody, and welcome to the webinar. I am Melissa Joy, and I'm so thrilled that you're joining us for the Spring Economic and Investment Update here at Pearl Planning. I am a financial planner and founder of Pearl Planning, joining you today from Dexter, Michigan, but we work with clients all over the country. And we know that many of you will be listening to this on our video replay, so feel free to follow up with questions. For those of our live attendees, we have a new feature, which most of you would be used to from other webinars. Now you can put in questions and answers in our Q&A section, and I'll be answering those at the end. Today's theme for our conversation is going to be using some of the lessons learned from the eclipse. We're really going to be focusing what happens in the world and what you think is going to happen. And the eclipse is certainly something that would be difficult to describe to someone who wasn't familiar with it. It's difficult to believe the awe that people that experienced the eclipse in totality experienced. This is a picture of two of the youngest members of the Pearl Planning family, Mila and my daughter Jo, who watched the eclipse in a 98% zone. And so I want to use some of those lessons learned that we all experienced recently and apply those to our investment conversations. Really, when we think about it, investing is both something that's technical and financial as well as behavioral. And there's emotions and psychology that's involved, and that's going to be an important theme today. So we're going to talk about, first of all, where markets are today. Coming in even from last year, markets tend to defy naysayers often, and certainly that's the case right now. And then we're talking about diversification, and it's important. We're also going to talk about bonds because there seems to be the whole crowd that spent the last 3 years predicting when the big recession was coming has now changed over to when are we going to lower interest rates, which is also seems to be a fool's errand that is not getting a lot of responses or answers from people. And then finally, I've learned a lot in the way I relate to clients and work with you and the way I manage investment portfolios from behavioral scientists and behavioral financial experts, such as Daniel Kahneman, Nobel Prize winner who passed away this month. And so I want to kind of reflect on some of those lessons learned and talk about what you can take away from such an important person. And then I'll have, of course, as always, suggestions for how we need to think about things going forward. So as we get started, kind of laying the groundwork, I want to look at the economy and investment returns just in general, where we are year to date. I would use the eclipse as an example of something extraordinarily dramatic that we all have learned about, but few of us have experienced. And I think economy and markets are also quite dramatic, just like eclipses. Now, in the eclipse, I think everyone's kind of bought in that is very special and unique. You've seen videos where people are experiencing totality. Not the case when it comes to the economy. We are in an election year, as we told you as we were reaching out to talk about this presentation. And so, it's inevitable that we should be talking about elections right now. And this gives us some very interesting data that we may not be used to seeing in other years, because everybody who's a pollster is really focused on certain states that are kind of the toss-up states that everyone thinks will decide the presidential election this year. And so in these states, there is a lot of polling that's done. I am not talking about who's going to win the election when I'm using this data, but it is really interesting to me when it comes to what people are thinking about the economy. So this particular visual, this graphic that I'm showing you today, came out in the Wall Street Journal last week, and it comes from polling data. And in that polling data, of course, people that are focusing on the elections know that the economy matters. And when you look at what people think about the US economy, this negative 30% or so is the differential between people that say the economy is bad versus the people that say the economy is good. What it means that it's to the left of the line is that everybody thinks the US economy, not everyone, but in general, in aggregate, people in showdown states think that the economy is not doing well. It's getting worse and is worse than the last 2 years. Now, interestingly, when you flip the question and you say, how's your local economy doing? How is your state doing? Whether you're sitting in any part of the country, if you're in Arizona, Georgia, Michigan, that's covering a lot of territory, all those swing states, They think things are doing decent in their home territory. Things are okay in my state, they're just not good in general. So, whereas we have a collective kind of community event of awe and agreement when it comes to an eclipse, there is a lot of disagreement between how people things are doing in their neck of the woods versus how the US economy is doing in general. Now, we do not use surveys and polls to see how the economy is doing ourselves. In fact, we use data, and that data, has been very consistently measured over many, many years. So here's a look at what was expected to be happening in the economy going back to Q4 of 2019, before anyone in the world had heard of COVID-19. And you can see the dotted trend line on the left of what the assumptions would be about where the economy might be going, chugging along 2.5% to 3%. Well, the green line is what actually happened. And we had that harsh and quick recession in the first quarter of 2020 that then turned into a quick rebound, going back to being a pace and then slowing a little bit. But we've actually had a pickup in the economy, something that no one thought was going to happen when they were in the business of predicting. So this is what is actually happening. Very different from what the survey information says. And that's not to say that there may not be cracks in the system. I'm not saying that things are all okay everywhere, but reflecting on data versus what people think, there is a giant disconnect. And of course, I love this Simpsons meme saying, how have I been wrong about the US economy? Well, I'm not wrong. Everybody else is. The data is wrong. I'm right. The reality is things are so complex. It's a lot more difficult to be right versus, what's kind of happening under the hood is actually occurring. And again, that does not predict what's happening in the future, but I just want people to be familiar with when you're listening to either pundits, the news, or people around your neighborhood at the water cooler, that there's a lot of pessimism in the face of things that might be considered optimistic otherwise. And of course, we need to deal with reality, and we also need to give you information and, in fact, stories that can help you to remain an investor. Why is that? Well, the world of investing is a long run game. And this is a look at just the returns of the S&P 500. It goes back to 1950, so a long track record. And in the green, you can see when the economy does well. And in the red, you can see when and I'm saying the economy, when investments do well, although you can see the little gray lines, those are lines for recessions. So oftentimes there is a pullback in markets at the same time that there's recessions. That tends to be causal. So you can see just a story of what kind of tends to go on in the market. And you may look at this and say, Melissa, I would really like to be invested during the green line, and I'll take a break during the red line. These two charts are not at the same scale, though. And when you put the scale together and you look in aggregate about the way that things work, the way that the world works, you can see that the green line is much bigger and taller than the red line when they're put together. So this is putting those two charts together going back to 1950. You flip from the green line when you're making money, and then when you have a drawdown, a pullback, a bear market of more than 20%, the chart flips over to the red line. And so the reality is it's really easy, whether your reasoning is because of the election that's happening in November, coming, another pandemic, debt and deficits in the US, a weakening dollar. It's really easy to have a reason to offboard for a while. But the challenge is that you lose out on those green lines. In fact, when you look at our next visual, if you were to, for example, and I could do this chart over and over again throughout history, if you take a minute off of the market just tends to get away from you. And this is a look in 2020. If someone chose to go to cash and then got a little interest from that cash, so you can see the orange line creeping up eventually, but what happens versus when you stay invested? And of course, those that stay invested, this doesn't predict the future, but those that have stayed invested in the past have been rewarded with more quality of life in terms of the ability to achieve their financial goals, since so many of us rely on the investments that we have in retirement accounts and otherwise in order to fund the second half of our lives, our retirement. Now, if I ask people what's going on today and why they may be frustrated with the economy, and certainly I would think that this would be under the numbers in different additional questions when it comes to why do people think the economy is bad in general. Inflation is certainly on the minds of both Main Street people as well as on the minds of investment professionals and economists. So inflation has been persistent. It was expected that inflation would be lower, and the Fed has had a target that was much lower, around 2%, for where they wanted inflation to be. And the reality is that prices just are not going down. In fact, they continue to rise. Now, they're not going up at the rate that we experienced a couple years ago. See in the chart on the left how high inflation went up and some of the components that were contributing to inflation. But the reality is that we just have this persistence of inflation, and this may be an ongoing experience that we are experiencing for a while. It's not just happening in the United States. So on the right, you can see a chart from the Eurozone. Again, inflation has been persistent. This is contributing to differentials in terms of how you perceive things. Now, I think it is of note and it is interesting to also be aware, though, that inflation is happening when it comes to wages as well. So, and this is going to be something we talk about when I talk about the lessons of Daniel Kahneman. It feels worse when you go to the store and you have to pay more for your bananas, or you have to pay more for your gas, or, the cost of housing continues to be persistently high in the face of high interest rates. But what we are seeing is that, well, let me go forward one more slide. Wage growth across the board in a variety of dynamics, whether we're talking about full-time employees, whether we're talking about males, females, college degrees, those who are younger workers. Wages are going higher as well. So we see a wage increase rate of around 5%. It doesn't feel as good as to kind of gain as it feels as bad to lose. So there's a multiplier effect on how much you feel like you're losing at the cash register, in spite of both for people working, your wages are going up. In many cases, I know that it's not for everyone, but just in general. People who are retirees, how are you seeing that inflation? Well, your portfolio values have also gone higher in many cases. Even if you're withdrawing from portfolios, you've been able to maintain purchasing power through the growth in assets. Also, Social Security checks have gone higher for the last 2 years. So keep that in mind, that there is some offset to that inflation cost story in the wage story. And that's not to say that it's healthy to have wages just through the roof forever, but there had been persistent low wages not keeping up with inflation even prior to COVID-19. So this is in some cases welcome news that there seems to be some growth in the average American's income. I want to go back one slide for just a moment, because what the economists do, what the federal government does in order to try to control inflation, is they bump up interest rates. So core inflation, producer price index, those have seemed to be high, not seem to, those are higher. And so how do you combat that? You increase the federal funds rate, you increase interest rates, that flows throughout the system. That's where you see higher borrowing rates, higher credit card rates, and mortgage rates, et cetera. And so on the bottom, you can see where the Fed fund rate was, next to nothing, and now where it is at 5.5%. And so many people, when they did their equations of what's going to happen in the stock market today and in the future over 2024, said, okay, we're just going to wait, because we know that the Federal Reserve is going to be lowering rates because they're going to see their target Fed funds rate. And this is just too high when it comes to where interest rates should be. Now, in reality, this is not an interest rate that we've never seen before. In fact, when I started working in financial services in the late 90s, money markets yielded 6%. In fact, and there was an environment where people were used to yield. And it may be the case that we don't have Fed funds rate going lower for a considerable amount of time. Why aren't they going lower? Because the economy is strong and inflation seems to be persistent. But do you want to remove that strength of the economy? I don't know, not necessarily if you ask me, but we may need to get more used to a higher interest rates for longer. And we'll spend some time talking about that in a moment. Another area that people are thinking about, I know we have some clients that want to own a second home. We have clients that are looking to kind of upgrade their house, but it is so expensive to get a mortgage, especially compared to where it was a few years ago. And home prices have remained quite strong. So the average US median sales price has come down somewhat over the last year or so. You can see that in the purple line on this chart, but also existing home sales have fallen somewhat, but neither are cratering, neither are going through the roof. It's also very spotty around the country. So some areas are getting a little softer while others aren't. So we don't see a persistent trend across the country. We don't have as much inventory in houses as we used to. And I think some of you might find it shocking to know that many of the people that are purchasing homes today, in fact, 32%, 1/3 of new home purchases are from a group of first-time home buyers. People may think, no, there's no way. How can they afford a house in this with interest rates? But people, go back to that note of increasing assets and increasing wages. People are able to find ways to borrow, and we're not in a lending environment where people are just giving away houses for free. So, don't also give yourself a narrative that you know exactly what's going to be happening when it comes to the housing market as well. We'll be prepared for anything. We always counsel our clients as we're making decisions, financial decisions about home purchases in the context of you, your life, and your needs and your ability to afford what you want to do. But this, I think, would be surprising for most people. Another interesting kind of detail there is that I say this is a big number, but about a quarter of people who are first-time home buyers are getting assistance with their family members, but the other 75% are just going it alone. They're using their own money. So I think this both shows that people are willing to spend money on a variety of things, whether it's higher end retail goods, whether it's home purchases, et cetera, but also under the hood, people aren't completely, underwater in terms of their personal balance sheet as the economy continues to grow. We told you in the invitations to this presentation that we were going to talk about the election because I feel like that is under the hood a lot of the conversations I'm having, especially with newer clients who aren't as familiar with kind of our context. But it's hard to ignore an election every 4 years. It is very important. Kind of my message is that the markets don't care about elections as much as people think. Elections are really important, but for other reasons. So don't let your focus this election year be solely how you need to kind of offboard your otherwise consistent investment plan because of this year. We always start out by talking about just hypothetically, like, do people make money in when different parties are in control of the White House? And the reality is that whether Republicans or Democrats control the White House, markets tend to go higher. And they don't necessarily look and see that, one party's in favor versus another. It just isn't the case. And I use this chart early and often. You look at the numbers, Democrats have performed better going back to 1929 than Republicans, but there is somewhat of an advantage because if you're sitting with your George W. Bush, you have 9/11 come up, a painful recession, and kind of double whammy with 2008 and 2009, not all his fault. Same with President Trump, who had COVID-19. That obviously was big economic impact and had not been resolved before there was a change in office. So I really don't think there's a causal relationship between one party doing better than another. We will talk about some of the implications of the election in more detail later in this discussion. I have not shown this chart before, and I really appreciated looking at it. It's data from Vanguard that shows what happens in a diversified portfolio, because often it's a lot easier to talk about the S&P 500. It's easier to get those charts than to look at returns in election years and non-election years when it comes to a mix of stocks and bonds, because that's what most of you have. And when you look at the annual compound rate during election years versus non-election years, good news, typically, and this is not a prediction, but it is statistically relevant, you have higher returns in election years than on average in non-election years when it comes to diversified portfolios by about 1%. I mean, the reality is both types of years tend to be stronger. The second year in an election cycle tends to be the weakest. So that would be 2 years ago. Certainly was super weak and added to those statistics. But the presidential election year tends to be a stronger year. We saw that in the first quarter. I pulled most of my data for this presentation last week, the week of April. Well, April 11th was when I pulled most of my data. And you may be thinking, gosh, Melissa, there's been a lot of pullback in stocks since April 11th. Yeah, that pullback's about 5%, 4 or 5% when it comes to the S&P. So not that huge, very typical, and I think actually very healthy. But I do like to focus on these longer, even though these aren't super long, 1-year numbers to give you some kind of hope as you're thinking, gosh, I'd just like to sit it out until we know who's going to be president. Another trend, another narrative that you may have been hearing about is that there's only really kind of 7 companies that are driving the returns of the stock market. And here's a look at those 7 companies through the end of March. They returned, I'm going to show you the companies in a second. They returned about 13%, while the S&P 500 returned about 8, and the other 493 companies returned 9 on an equal weighted basis. So interesting that you have this differentiation where some of the bigger companies didn't do as well. That's why the S&P would have done better than both or worse than both of the others. Now, let's look at the attribution. You've got NVIDIA giving a bunch of those returns. They just had very heady numbers in January and February. And then you go across the board, you see your Google, your Microsoft, Meta, Amazon, Berkshire, Lilly. Tesla's kind of been knocked out of the bunch because they're doing quite poorly. But the S&P 500 with everything else returned 5% in their cap weighted. Now, cap weighted means the biggest companies get a bigger percent of performance. So it's a little bit of a shift where there's more kind of returns coming from different parts of the publicly traded companies. I think that's good news. And keep a note from our conversations last year that I don't think it's negative if you had a very small concentration of returns in a really good year. That just means there's other places where we can find opportunities for growth over time. Speaking of growth, we also, when we're geeks like investor geeks like me, we look at the growth versus value. That's another way to diversify. If you looked at the S&P 500 right now, it would be tilted toward growth. That's just because there's tech is a bigger portion of the economy. You've had those really strong companies that have contributed a lot to returns. And there's still persistence where growth is outpacing value year to date. And so we'll watch and see if that changes. The last time it was really rewarding to be a value investor versus a growth investor was a bad year for the market in 2022. And so we want to make sure that we're continuing to put some money into value investments because we know it helps with diversification over time, which can help you ride out more difficult markets and be a more successful investor over longer periods of time. So I am covering a lot. I want to make sure if you do have any questions that you're putting them in our Q&A, but I want to then draw together from some of the things that I've discussed, what I want you to remember from here. First, I love the work of Daniel Kahneman. His book, Thinking Fast and Slow, was probably one of the most informative, if not the most informative book when it comes to perspective on how you need to think as an investor. It's easy when you sit in an economics or finance class in college to think, charts are everything. But in investing, whether you're a professional or a personal investor, the reality is that there is so much of your behavior that it matters in terms of how you think about your investments, your relationship with your money, etc. At Pearl Planning, we really devote ourselves to trying to make that focus really be in sync and work for you instead of against you. What are some examples about how investing can work against you? Well, one is, and this is a lot of Daniel Kahneman's work. I've listened to some of his interviews after he passed away, just, reminiscing about the power that he had, is you are a descendant of people that needed to stay safe in order to stay alive. To overgeneralize radically, we can call those our caveman descendants, or we're descendants of cavemen. And, if you were out on, living your life in many, many moons ago, many generations ago, where there were predators that could attack, whether they're other humans or animals, then you needed to be extraordinarily careful and fearful. And your reflexes to fear allowed you to think very quickly and try to protect yourself when things seemed dangerous. Well, that same kind of DNA wiring that helps you to stay alive also is how you bring yourself to investing. And the goal of a financial planner, when done well to me, is to allow you to have space to think slow as well. That's why we talk about investment lessons, whether the market is up or down. That's why we talk about narratives that help you to understand why you want to stay invested. Kahneman talked about how he is not a huge fan of happiness research. He talks about how he doesn't know if it's the job of a psychologist or an economist to make people happy, but he did see profound value in reducing misery, which is a different thing. So, reducing pain, reducing less happiness, the opposite, he said was important. I think that's really interesting because a lot of my thought over the years has been thinking about contentment for people instead of kind of abundant joy as being a more naturally advantageous kind of thing to seek when it comes to your relationship with money. And so when you think about reducing pain, I mean, I would give examples of how good did last year feel when the markets were up double digits versus how bad did the year before feel when inflation was super high and markets were down double digits. If you're the average person, then it would feel much worse than it feels good. And there would be a net misery index. I feel like people who are able to manage through with the assistance and wisdom of kind of a thinking partner, like a financial planner, are able to navigate that with less of that pain, less of that misery. And that's something that we really try to instill both in these discussions often, as well as in how we think about setting all types of things up with how we work with clients. Even our investment policy summary, where we provide a summary of how we're going to invest, is a behavioral kind of tool where we kind of make an agreement and you sign it. So then when you deviate, you need to sign something else. And it's kind of, again, it allows you to think a little bit slower. We could talk all day about the lessons of behavioral finance. I should make a note that this should be a future webinar and recording. So I will do that. But I thought it could be summed up. I didn't put the name of this quote. It's actually from Andre Agassi's book. But he said, I don't feel that Wimbledon has changed me. I feel, in fact, as if I have been let in on a dirty little secret. Winning changes nothing. Now that I've won a slam, I know something that very few people on earth are permitted to know. A win doesn't feel as good as a loss feels bad. And the good feeling doesn't last as long as the bad, not even close. I mean, gosh, how harsh from a world champion in his biography to talk about how bad it feels to lose and how, kind of fleeting it is to win. I hope with context of, our conversations, tying your money to your life, that you can feel less like this and more like your money is helping you to satisfy the things and your goals in life, and that thus you are fulfilling the function and your responsibility to taking care of yourself and your family. And I think it's important to understand the lessons of Dr. Kahneman in order to understand that what Andre Agassi is talking about is exactly how people tend to think if you don't have that kind of speed bump to say, wait, everything's okay, things are going well. So while we're talking about important lessons, another important lesson that I think is just growing is just the preponderance of advice from people who have less education when it comes to finances. This is a look of a study that was highlighted by Tracy Alloway on Twitter that talks about an academic research study. Unskilled and anti-skilled, like the opposite of truth, finfluencers have more followers, more activity, and more influence on retail trading than skilled finfluencers. And, I don't know if we would call ourselves finfluencers, but we are skilled. We have licenses. We have fiduciary obligations to act in the best interest of people. Even in this advice, I've had, a legal department review what I'm going to be telling you to make sure it's not promisorial. inappropriate and it has appropriate disclosures. And I just think it's important, whether you're thinking for yourself or you're thinking for education of people who are important to you, that you are receiving advice and information from people who have knowledge. In a world of Chat GPT, where you can get really great information by plugging them in, or really horrible information. In a world of TikTok, where you can get great advice from skilled people, although many of us are precluded from putting advice out there because of compliance restrictions, versus information from people who have no idea what they're doing, or may be selling something that would be very rewarding to them and very harmful to you, that it is critical to get your information, just like your news information, from credible sources. Having one-on-one discussions with your financial planner, financial professional, making sure that you have a sounding board to know whether what you're hearing is accurate. That is a theme that I think we're going to have to be talking about from here on out. I mean, it definitely comes into how teens and 20-somethings are being educated. And hopefully there is more access to skilled information, as well as more implications when people give anti-skilled or unskilled information. But for now, I think it's important to emphasize that in terms of where we go from here. Okay, off of my soapbox, let's talk about some more kind of numbers. I think if people are thinking, oh my gosh, things are really, I'm concerned about where things are in markets, I want you to understand that earnings growth has been an important component of returns when it comes to stocks. So we don't just have like no earnings and stocks going up for no reason. And when you look in the chart on the left, earnings for the rest of the year are expected to be higher than last year, same on into 2025. We've actually had a lot of earnings surprises when it comes in the first quarter, surprises on the positive. So keep that in mind when you look in aggregate on the returns since 2020. More than half of those returns have been because of earnings growth. So again, that just is indication that we don't see signs that companies are unable to make money in today's market. Okay, another theme that I think we have to address right now, I'll probably use this chart again in future presentations, is great detail from JP Morgan on CD rates when they peak versus the rest of the returns for other investments. Because we had this new novel kind of investment opportunity, new, old is new again, last year, where you could get 5 to 6% returns on CD rates. Sounded pretty darn good when in bonds were not giving us much and stocks were coming off of a really low year. Well, now we've had stocks in a good year, and I'm not saying that CDs are bad. I think that they're good for shorter term money, but do keep in mind in the past when CD rates have been quite high, and when they reach their peak, then the returns looking forward on CDs, which are locked in typically, versus the returns of bonds, stocks, and a 60-40 portfolio have almost always, excepting the case of year 2000, been higher. So do not bail on your investment strategies for CDs only. This is really important to remember because it can feel so certain and so good to have those CD returns. And I'm not saying you shouldn't own CDs, but you should own it based on your investment strategy and your financial plan, and not just bail completely on the other types of investments. I've told you that we think inflation may be here for longer. We don't know. And interest rates could stay higher for longer. But right now, short interest rates for like 1 and 2 year CDs are much higher, or measurably higher, I should say, than longer interest rates. And we could still have interest rates stay high without CD rates staying as high as they are. They could come down a little bit. That would do a wonky thing called normalizing the yield curve, whereas it's been inverted in the past. So just keep that in mind. CD rates are good, but don't over purchase. Don't fall in love with CD rates at the expense of your overall investment process. And again, I'll probably repeat this like I do some of my other slides because it's really important to remember over time. Speaking of bonds, first of all, I just want to show you how much higher interest rates are than they've been over the last 10 years. Even though bonds year to date do not look good, again, the bond returns are negative. We were sitting at a negative year to date bond return last October, and everything changed in about 2.5 months, and bonds had positive returns last year. Well, we're still sitting in a place where you get paid to own bonds, even if their price is floating around or even perhaps going down. The reason the prices have gone down over the last month or two is because inflation remains persistent and higher, and that gets priced into the bond market immediately. But while you own these bonds where their prices are fluctuating, you also are being paid a yield. And when you see that blue dot on this chart, that yield, or blue diamond, I should say, that yield is much higher than it has been. It's much closer to the high end of its 10-year range. Do keep that in mind versus the average and the median, and know that as a retiree, bond investors look a lot better than they used to. It's also a time period where people have just been really darn comfortable owning the S&P 500 because it's done so well for so long. And I still am a large advocate for diversified portfolios with the appropriate risk metrics. I'm going to continue to use this chart because we really haven't seen the impact of falling rates. And I know I just said that rates may stay higher for longer, but do keep in mind that bonds are offering more in yield today per unit risk. And then the math changes versus where it was much, much worse when interest rates were nowhere or zero. It was much worse for rates to rise by 1% than it would be today. So the 1-year return, if interest rates went 1% higher today, would be theoretically negative 0.8%, versus if rates stay unchanged and they're at 5.5%, rates stay at 5.5%. I'm taking numbers from September 2023, but we're in that same range. And then if rates were to fall by 1%, you would have significantly higher stock returns, or bond returns, I should say. Now, why might rates fall? Well, that probably means inflation is more under control, or the economy seems to be faltering. These are times where diversified portfolio would be really useful. And so I just want to keep reinforcing the layers of there is a purpose to bonds in your portfolio. And, we manage to what types of bonds we want to own, how we want to own them. Keep that in mind as well. There are always reasons to sell. And I will probably use a chart like this forever because it shows, and we call these mountain charts in our speak, it shows just the growth of stocks over time, even when horrible things are happening. So the last kind of black line we put in was when the Fed funds rate went to 5.5%. Markets decided to go up. They happen to go up 7 out of 10 years, even when there's pullbacks, every other year at least there's a 10% correction. Bear markets happen more and more frequently, and yet in aggregate, there is growth over time. When it comes to investing at all-time highs as well, I know we're just slightly off of the all-time highs when it comes to the S&P 500, but typically investing at all-time highs is not a horrible place to be invested. It's all those green lines in the chart on the left. Those green dots are times when the market was at or near all-time highs and then continue to go higher. And investing at or near all-time highs tends to not be the worst day to invest. If you just chose not to be an investor at all-time highs, you'd be sitting out a lot of the market. And that has the implications that we showed otherwise of, just the challenges of being an investor, a part-time investor. Don't be a part-time investor. This chart I use all the time too. It's been updated. We used to show a 50-50 portfolio, but this is more accurate to kind of a quasi-retiree portfolio of 60% stocks, 40% bonds, but it just shows you over 1, 3, or 1, 5, 10, and 20 years, how often markets are higher. What are the ranges of returns? And you need to be ready for anything in a month, 3 months, and a year. But returns become more compact, more consistent, and more reliable the longer period of time you're willing to invest. And so, there is that one in the green bar period of time where markets were negative. I was an investment professional during that time, the lost decade between 2000 and 2010, where you had both the tech wreck as well as the Great Recession. I use this as an example for people who just say they only want to own the S&P 500 for the rest of their lives. Might work okay if you're always accumulating, you're always buying. If you're also going to be doing portfolio withdrawals, it's not bulletproof. And if you withdrew 4 to 5% during that 10-year period starting in 2000, you'd really have a challenge having and maintaining an investment portfolio. You would have had to take significant haircuts in terms of how much you spent in retirement. And another reminder for the power of diversification. This too, we've been coming through period of time where it has been really nice to be invested in only the biggest companies of the S&P 500. It's comparing to the gray line, which is time periods where it's better to be invested equal weighted across S&P indexes or the 500 stocks of the S&P. And I think this is a good example of why investing in smaller companies may make sense. There's just times when one or the other is in favor. And for the last 10 years, like the biggest companies, if you were to look at it kind of in aggregate, would have been the best. But that's not always been the case. And I learned a lot of my investment lessons through my first rough markets in between 2000 and 2010, the time period I was just mentioning, where there were a lot of value in owning international investments as well as owning smaller investments. Speaking of international, again, well, small and mid as well as international, we've continued to have underperformance in small cap, but it seems to be coming more in line. It'll be interesting to see. We've kind of repositioned some of our small cap positions in our portfolios to be ready to start to add to our small cap position percentages at some point soon. Not quite yet, but large cap has been outperforming. Now, that being said, there was a significant time period where small caps outperformed. In fact, 19 years starting in 1999. So do keep that in mind that it's not, even though recently it feels like there's not a lot of value in mid and small, and it would just be easier to own less kind of holdings. There are some really important time periods that were really challenging for investors where small caps could have provided some extra lift. Same goes for foreign stocks. Same goes for international, where there's just a bigger kind of alligator jaw between US stock performance and foreign stock performance. In this chart, we're actually looking at kind of the pricing for foreign stocks versus the US, and that pricing looks pretty darn good. So we'll continue to be investors in international. We've owned less international than we have in most of our careers, but we're prepared and positioned if we want to kind of add to those portfolios over time. Now, if you listen to our presentations often, you will know that I use this chart often. It's the Emoji's Guide to Investing, and you may live through the heartache and the victories of investing, that roller coaster of emoji emotions. But the best investors are able to take action like the flat face, where they really are disciplined and successful over time by sticking to their process and not riding that roller coaster in terms of their actions. That is our job. We really measure our success by you sticking to your process. That is the batting average that matters the most to us. I know that many of you have really stuck with us through these challenges and keep up the good work. And I'm probably never going to get rid of that kind of slide as a reminder, just like this one. It's so easy to think, while all the news is good and you're sitting and you're told the eclipse is going to be amazing, you're in totality and you're just not sure. You just don't know if you believe. It's so easy to sit under your umbrella looking for all of the problems while it's sunny outside. Don't miss those opportunities. Don't jump to the worst case scenario assumption. Do be disciplined and evidence-based in how you choose to invest. And of course, I wouldn't be who we are if we weren't advocating for the power of financial planning in helping you to tie into your investment life. If you don't have a formal financial plan, things can feel much more difficult. Studies show that. And with advice, you can feel much more confidence in terms of whether or not you will be able to reach your goal. Information is power, and not just focusing on, the daily returns of the S&P 500, but also focusing on your life and how everything fits in, how much risk you need to take. Things like that can be extraordinarily powerful. I added this, though. This is a new slide for our presentation, talking about how family, career, materials, well-being are among some of the most satisfying, kind of factors for feeling like your life is meaningful. Certainly when I'm thinking about contentment, when I'm thinking about behavioral economics and behavioral finance, I want clients like you to have the opportunity to see that value, whether you value the work that you're doing, whether you feel like you have a sense of well-being, not just materially, but also your physical and mental health. where you feel a sense of community. Those are important to remember. And also that sense of well-being isn't solely dependent upon your money, although of course money is very important to achieving some of the other things on the list. Okay, so what are your best actions for right now? Remember, elections matter, but less so for markets, and your investment process includes things built in for the election. Watch for tax discussions though, because I anticipate by the fourth quarter presentation, I'm really going to be focusing on what we think may be happening with the Tax Cuts and Jobs Act sunset at the end of 2025. So this is going to cause a lot of speculation. There's likely going to be necessary to be a multi-party kind of agreement on things because the odds of having, one party or another control all of the houses are TBD. And then to make a Senate bulletproof for filibusters means that both parties will be in play. But we do have legislation that's sunsetting a lot of different conversations about what taxes may look like. And also that might have impact on estate taxes, something that does not isn't in play for most of you. Estate taxes only come into play for people north of $10 million nowadays, but that could change. Do focus and update your financial plan. Your financial plan should include investments, but make sure that you're looking at the big picture and you're looking at your personal circumstances. Don't take information from the finfluencers or whatever your version is, the people at the water cooler that don't know your personal circumstances. They may have good general advice or they may not, but they do not know you and your life unless you're giving them a lot of information. So don't assume that, kind of well-intended information that is blanketed has the full power of personalized information. Do keep emergency cash on hand. We never know what's coming around the corner. We always advise our clients on a level that feels comfortable based on their balance sheet and their personal circumstances. And then do ignore distractions. Just keep swimming. We will continue to keep you informed, whether it's on legislation, markets, or government, so that you feel you have information that's relevant to your life and your portfolio. And don't be distracted. Don't be consumed by pessimism when there's wonder with something like an eclipse or the power of stock markets. Don't feel the need to amplify your pain. Do focus on well-being and contentment, just like those moments in the eclipse. Okay, what's next? I just want to give you a few resources as I also give you the opportunity for Q&A. I don't see any questions like right now, but if you did miss something in the presentation or want to share it with friends, we'll have it on our YouTube page shortly, as well as on our website under our blog. If you would like a complimentary investment allocation review and you're listening to this, don't hesitate to reach out to me. You can just go to our website, pearlplan.com, and schedule an introductory conversation. Attending our next webinar, we will be presenting on June 12th on how to prepare for an early retirement. We'll have plenty of good information for retirees as well. So if you've already gotten into that retirement phase, we'll make sure we're talking to you as well. Weekly, we have the Women's Money Wisdom podcast. Episodes come out on Tuesdays, and we have new episodes each week. Really interesting. We have a discussion coming up in a couple weeks, human rights discussion, and how it relates to optimism, whether it's about humanity or markets, with William F. Schultz, who's the past executive director of Amnesty International USA. So we're really bringing some great guests to those conversations. And even though it says Women's Money Wisdom, I think men would feel welcome and included in those conversations. And then on our website at pearlplan.com/newsletter, you can subscribe to our newsletter. Of course, here are those disclosures that show that our legal department is listening and we're not just flinging financial advice out to you without context or, kind of grounded in truth. We're making sure that our advice is grounded in truth. And then if you do have any questions, you can feel free to call us as follow-up. My email address is melissa@pearlplan.com. And on behalf of our entire team, I just thank you for this time and welcome ongoing follow-up conversations. Thank you.